I need to warn you about something that could devastate your portfolio over the next 12 to 18 months. There are three trades that have become so popular, so crowded, so universally accepted as obvious winners that almost everyone I talk to owns them. Hedge funds own them, pension funds own them, retail investors own them. Your financial advisor has probably put you in them, and they are all about to reverse violently. I have been managing money for over 40 years. I ran one of the most successful hedge funds in history, generating average annual returns of 30% with no losing years. I learned from George Soros. I made $1 billion in a single trade shorting the British pound in 1992. I have seen every market cycle, every bubble, every crash, every reversal that has occurred since the late 1970s. And I am telling you that the setup right now is as dangerous as anything I've seen in my career. The trades I am about to describe are not bad ideas in principle. They made sense when they were initiated. The problem is that everyone piled in at the same time, creating extreme positioning that makes these trades vulnerable to violent reversals. When everyone is on the same side of a trade, there is no one left to buy. And when the narrative shifts, when the first cracks appear, the stampede for the exits will be brutal. Let me take you back to 2000. And when I learned the most expensive lesson of my career about crowded trades, the technology bubble was inflating. Everyone knew internet stocks were overvalued. I knew they were overvalued. But I also saw that they kept going up, and I convinced myself that I could ride the momentum and get out before the crash. I bought technology stocks near the peak because I thought I was smarter than the market, thought I could time my exit perfectly. I lost $3 billion in a matter of weeks. $3 billion, not because I did not understand the fundamentals, not because I could not see the bubble, but because I underestimated how violent the reversal would be once it started. When crowded trades reverse, they do not give you time to react. The move happens faster than anyone expects because everyone is trying to exit through the same door at the same time. That experience burned into my brain, a lesson I have never forgotten. When a trade becomes consensus, when everyone owns it, when it seems like the most obvious thing in the world, that is precisely when you should be getting out. Not because the fundamental thesis is wrong, but because the positioning itself creates fragility. The crowding is the risk. Right now, I see three trades that have reached that level of crowding, three trades where the consensus is overwhelming, where positioning is extreme, and where the potential for violent reversal is enormous. I am going to tell you exactly what they are, why they became so popular, and why I believe they are about to turn against the millions of investors who own them. Here is what I am watching. First, the artificial intelligence mega-cap trade that has everyone convinced technology stocks can only go up. Second, the short treasury trade that has hedge funds betting interest rates will stay higher for longer. Third, the long dollar trade that has become one of the most crowded positions in currency markets. Each of these trades made sense at some point. Each has a compelling narrative behind it, and each is now so crowded that the reversal, when it comes, will be devastating. Let me start with the trade that concerns me most because it affects the most people. The artificial intelligence trade, the Magnificent Seven. The idea that a handful of technology giants will capture all the value from artificial intelligence and therefore deserve unlimited valuations. I want to be clear about something up front. Artificial intelligence is real. It is transformative. It will change the economy in profound ways over the coming decades. I am not questioning the technology. I am questioning the trade, because there is a massive difference between a technology being transformative and the stock being a good investment at current prices. The internet was transformative. It changed everything about how we live, work, and communicate. But investors who bought internet stocks in 1999 at the peak of the bubble lost 80, 90, 95% of their money, even though the technology thesis was completely correct. Amazon fell over 90% from its 2000 peak. It took more than a decade to recover. The technology was right. The timing and the valuation were catastrophically wrong. I see the same dynamic playing out today with artificial intelligence stocks. NVIDIA has become the poster child for this trade. The company makes the chips that power AI training and inference. Demand has been insatiable. Earnings have exceeded expectations quarter after quarter. The stock has gone up over 800% in 2 years, and everyone owns it. When I say everyone, I mean everyone. NVIDIA is the largest or second largest position in almost every growth mutual fund. It is heavily overweighted in every momentum strategy. Hedge funds have piled in. Retail investors have piled in. It shows up in thematic ETF sector ETFs, broad market ETFs. The concentration of ownership is staggering. And here is what worries me. The narrative has shifted from NVIDIA being a great company to NVIDIA being a company that cannot possibly disappoint. The expectations embedded in the stock price require perfection, not just continued growth, but accelerating growth at rates that defy gravity. Any hint of deceleration, any suggestion that demand might moderate, any competitive threat from AMD or custom chips from hyperscalers, and this stock will get repriced violently. I have seen this movie before. Cisco in 2000 was the NVIDIA of its era. The company made the networking equipment that powered the internet. Boom. It was real technology with real demand. Cisco was the most valuable company in the world at the peak, and it fell over 80% and never recovered its highs. Not because the internet was not real, but because the valuation assumed perfection that could not be delivered. The broader AI trade concerns me even more than any single stock. The market has decided that a handful of companies will capture all the value from artificial intelligence, and that these companies deserve to trade at historically extreme multiples. The Magnificent Seven now represent over 30% of the S&P 500, a concentration that exceeds even the dot-com bubble peak. But the history of technology is that incumbent advantages erode faster than people expect. The leaders of one technology generation are rarely the leaders of the next. IBM dominated mainframes but missed the personal computer revolution. Microsoft dominated PCs but nearly missed the internet and completely missed mobile. Intel dominated processors for decades and is now struggling to compete. The assumption that today's AI winners will be tomorrow's AI winners is historically naive. I am not saying to short these stocks. Timing the reversal of a crowded trade is extremely difficult. What I am saying is that the risk-reward is terrible. You are taking enormous risk for limited upside because most of the gains have already happened. When this trade reverses, and it will reverse, the losses will be concentrated in the portfolios of people who thought they were being smart by owning what everyone else owned. There is another dimension to the AI trade that concerns me, the capital expenditure cycle. The hyperscalers, meaning Amazon, Microsoft, Google, and Meta, have announced hundreds of billions of dollars in AI infrastructure spending. This spending is what is driving NVIDIA's earnings. But capital expenditure cycles are notoriously cyclical. Companies overinvest during the boom, build excess capacity, and then sharply curtail spending when they realize they have built too much. I have seen this pattern repeat across technology cycles. The fiber optic build-out of the late 1990s led to massive overcapacity and a collapse in telecom equipment spending. The solar panel build-out of the 2010s led to overcapacity and collapsing margins. Every technology that is obviously transformative attracts too much capital, builds too much capacity, and then experiences a painful adjustment. The AI infrastructure build-out is following the same pattern. Data center construction is booming. Chip orders are at record levels, but the revenue that is supposed to justify all this spending has not materialized for most companies. Outside of Microsoft and a few others, most companies deploying AI are not seeing measurable returns on investment yet. At some point, CFOs are going to start asking hard questions about AI spending, and when that happens, the capital expenditure cycle will turn. I am not saying AI is a fad. I am not saying the technology does not work. I am saying that the stocks have priced in a perfection that is unlikely to be delivered. The trade has become so crowded, the valuation so extreme, the expectations so elevated that disappointment is almost inevitable. And when disappointment comes to a crowded trade, the reversal is violent. Now let me tell you about the second crowded trade that is about to reverse. The short treasury trade. Hedge funds and institutional investors have built massive short positions in treasury bonds, betting that interest rates will stay higher for longer, that inflation is entrenched, that the Federal Reserve will keep rates elevated, and that bond prices will continue falling. This trade has been enormously profitable. Bonds had their worst year in history in 2022. They fell further in 2023. Anyone short treasuries has made significant money, and now the trade has become consensus. Commitment of traders' data shows hedge fund short positions in treasury futures at or near record levels. The conviction that rates are going higher is overwhelming. But here is what the bond bears are missing. Economic data is weakening. The labor market, which has been surprisingly resilient, is showing cracks. Job openings are declining, hiring is slowing, wage growth is moderating. The consumer, who powered the economy through higher rates, is running out of ammunition. Credit card balances are at record highs. Delinquencies are rising. Savings accumulated during the pandemic have been depleted. I have spent 40 years studying economic cycles. I know the patterns. The economy does not weaken gradually and then stop at some equilibrium. It weakens gradually and then accelerates into recession. The leading indicators that have historically predicted recessions, the yield curve inversion, the decline in leading economic indicators, the tightening in lending standards, they are all flashing warning signs. Not everyone agrees with this view, but that is precisely the point. When everyone agrees that rates are staying high and bonds are going lower, when that is the consensus, that is when the reversal comes. Think about what happens when recession fears increase. The Federal Reserve cuts rates, potentially rapidly, bond prices rise. All those hedge fund shorts become losses. And because the positioning is so extreme, the covering will be violent. Hedge funds will race to buy back the bonds they sold short, pushing prices higher, triggering more covering, creating a self-reinforcing spiral. I have seen this happen before. In 2001, the consensus was that the Federal Reserve was done cutting rates, that the economy had achieved a soft landing, that rates were going back up. Bond shorts were popular. Then the economy rolled over faster than anyone expected. The Fed cut rates from 6.5% to 1% in about a year. Bond prices soared. The shorts were destroyed. The same thing happened in 2008. The same thing happened in 2020. Every time the economy weakens more than expected, bonds rally violently, and the crowded short trade reverses with devastating force. I am not saying to bet on a recession. I am not saying I know exactly when the economic data will turn decisively negative. What I am saying is that the risk-reward on the short treasury trade is terrible right now. You are short an asset that pays you positive yield while you wait, which means the carry is working against you. You are positioned the same way as everyone else, which means you will not be able to exit gracefully when the trade reverses. And you are betting against an asset that has historically been the best safe haven during economic stress. The bond market has a saying, the trade that works until it does not. Short treasuries has worked. It has been profitable. That is exactly why it has become so crowded, and that crowding is precisely what makes it dangerous going forward. Let me explain the mechanics of why bond reversals are so violent. When hedge funds short treasury futures, they are essentially borrowing bonds and selling them, hoping to buy them back cheaper later. To do this, they use leverage, substantial leverage. A hedge fund might have $1 of capital supporting $10 or $20 of short bond exposure. This leverage amplifies gains when the trade works, but it also amplifies losses when the trade reverses. When bond prices start rising, these leveraged shorts face mark-to-market losses. Their prime brokers demand more margin. If they cannot post additional margin, they are forced to cover their shorts, meaning they have to buy bonds. This buying pushes prices higher, which triggers more margin calls, which forces more buying. The mechanics create a self-reinforcing spiral that can move prices far more than fundamentals alone would suggest. I have seen these short squeezes happen multiple times in my career. They are always more violent than anyone expects. The 2008 Treasury rally, when 10-year yields fell from 4% to under 2% in a matter of months, destroyed hedge funds that were short bonds. The March 2020 Treasury rally, when yields collapsed as the pandemic hit, created billions in losses for short sellers. The magnitude of the moves is always surprising because people underestimate how much leverage is in the system. There is also a fundamental argument for why bonds might rally from here that has nothing to do with recession. The supply and demand picture for treasuries is actually improving. The Treasury has shifted issuance toward shorter maturities, reducing long-dated supply. Foreign buyers, particularly Japanese institutions, are returning to the market now that currency hedging costs have declined. And if inflation continues to moderate, the real yield on treasuries becomes increasingly attractive. I am not pounding the table saying to buy bonds today. I am saying that the short treasury trade is crowded, leveraged, and vulnerable to reversal. The risk-reward does not favor maintaining or adding to short positions. And when the reversal comes, the violence of the move will surprise people who thought they had time to react. Now let me tell you about the third crowded trade, the long dollar trade. Currency traders and macro hedge funds have built substantial long positions in the US dollar against virtually every major currency. The thesis is straightforward. The United States has the highest interest rates in the developed world. Money flows to where it is treated best. Higher rates attract capital. Capital flows support the currency. This trade has worked beautifully for the past several years. The dollar index has strengthened substantially. The dollar is at multi-decade highs against the Japanese yen. It has strengthened against the euro, the British pound, the emerging market currencies. Anyone positioned long dollars has made money, but the crowding is extreme. Speculative positioning in dollar futures is at levels that have historically preceded significant reversals. Every macro hedge fund I talk to is long dollars. The conviction is overwhelming, and when conviction is overwhelming, when everyone is positioned the same way, that is when the trade is most vulnerable. Here is what I think the dollar bulls are missing. Interest rate differentials matter, but they are not the only thing that matters. And the interest rate differential that has supported the dollar is likely to narrow, not widen. From here, the Federal Reserve has signaled that its next move is likely to be a rate cut, not a rate hike. The exact timing is uncertain, but the direction is clear. Meanwhile, other central banks, particularly the Bank of Japan, are moving in the opposite direction. Japan has finally ended its negative interest rate policy. Japanese rates are moving higher, while U.S. rates are likely to move lower. That narrowing differential removes the primary support for the long dollar trade. There are also structural factors that argue against continued dollar strength. The U.S. fiscal position is deteriorating rapidly. The federal deficit is running at 6 to 7% of GDP, even with low unemployment and a growing economy that is historically unprecedented. This fiscal profligacy will eventually undermine confidence in the dollar, especially as the Treasury issues trillions of dollars in new debt that the market must absorb. Foreign central banks, particularly in Asia and the Middle East, are diversifying away from dollar reserves. This is a slow process, not a sudden collapse, but the marginal buyer of dollars is becoming less reliable. The assumption that foreigners will always want to hold unlimited amounts of dollar-denominated assets is being tested. The technical picture is also concerning. The dollar index has made a series of lower highs despite the interest rate advantage. This is a classic sign of a market that wants to go down but is being held up by positioning and flows. When the dam breaks, when the first sustained move lower begins, the covering of long positions will accelerate the decline. I made a fortune trading currencies. I understand how these markets work, and I am telling you that the long dollar trade is extremely crowded and extremely vulnerable. The catalyst for reversal could be weaker U.S. economic data, Fed rate cuts, stronger data from Europe or Japan, or simply exhaustion of the buying power that has supported the trade. But the reversal is coming. The only question is timing. Let me share some history about dollar cycles because it provides important context. The dollar moves in long cycles, typically lasting 5 to 7 years. The current dollar bull market began in 2011. We are now over a decade into this cycle, which is historically extended. Every previous dollar bull market of this duration has ended with a multi-year bear market that erased most of the gains. The 1985 Plaza Accord is instructive. The dollar had strengthened massively in the early 1980s due to high U.S. interest rates and strong capital inflows. It seemed invincible. The consensus was that dollar strength would continue indefinitely. Then the major economies coordinated to weaken the dollar, and it fell over 50% against the yen and the Deutsche Mark over the following 2 years. Positions that had taken years to build were destroyed in months. I am not predicting another Plaza Accord, but I am noting that dollar cycles turn often more sharply than anyone expects, and that the current cycle is historically mature. The long dollar positioning is extreme. The fundamental support from interest rate differentials is likely to narrow. The fiscal trajectory raises questions about long-term dollar credibility. All of these factors argue for caution, not for adding to long dollar positions. There is also the question of what happens to other assets. When the dollar turns, a weaker dollar is historically bullish for commodities, for emerging market stocks, for gold, for international equities denominated in foreign currencies. The reversal of the long dollar trade could trigger rotations that catch many investors off guard. I have positioned my portfolio with significant exposure to assets that would benefit from dollar weakness, not because I am certain the dollar will fall, but because the crowding in the long dollar trade means the reversal, when it comes, could be substantial. I want to benefit from that reversal, not be hurt by it. Now let me pull back and explain the broader principle that connects these three trades, because understanding this principle is more important than any specific trade recommendation. Markets move in cycles of consensus and contrarianism. When a trade first emerges, it is contrarian. The early adopters are going against consensus, taking a position that most people think is wrong. If they are right, the trade works, and more people pile in. The trade becomes popular. Eventually, it becomes consensus. Everyone owns it. Everyone thinks it is obvious. And that is precisely when it becomes most dangerous. The transition from consensus to reversal is not gradual. It happens suddenly, violently, without warning. One day everyone agrees that tech stocks only go up, that rates are staying high, that the dollar is strong. The next day the narrative shifts, and everyone is trying to exit at the same time. The moves are far larger than anyone expects because the positioning is so extreme. I have watched this pattern play out dozens of times over 40 years. The lesson is always the same when a trade becomes consensus, when everyone owns it, when it seems like the most obvious thing in the world. You should be reducing exposure, not adding to it, not because you know exactly when the reversal will happen, but because the risk-reward has shifted against you. The three trades I have described today, long AI mega caps, short treasuries, long dollars, have all reached the consensus phase. They all have compelling narratives. They have all been profitable, and they are all crowded to an extreme degree that makes them vulnerable to violent reversal. Let me tell you how I think about positioning in this environment, because avoiding crowded trades is not enough. You need a framework for what to do instead. First, I reduce exposure to consensus trades even if I think the fundamental thesis is correct. I would rather miss some upside than be caught in the reversal. The last 10% of a trend is not worth the risk of the first 10% of the reversal second. I look for asymmetric opportunities on the other side of crowded trades. If everyone is short treasuries, there may be an opportunity to be long. If everyone is long dollars, there may be an opportunity to own currencies that have been left for dead. The best trades are often the ones that nobody wants to own. Third, I maintain significant liquidity. When crowded trades reverse, there are incredible opportunities for those with cash to deploy. But you can only take advantage of those opportunities if you have capital available. Being fully invested in consensus trades means you have no ammunition when the reversal creates bargains forth. I pay attention to positioning data, not just fundamental data, the commitment of traders' reports, hedge fund positioning surveys, flow data from prime brokers. These tell you where the crowding is. Fundamental analysis tells you what should happen in theory. Positioning analysis tells you what might happen in practice when the crowd rushes for the exits. Let me also share what I am watching for as potential catalysts that could trigger these reversals for the AI trade. I am watching for any sign of slowing demand growth, any earnings miss from a major player, any indication that the AI spending boom is moderating. The valuations are priced for perfection. Anything less than perfection will be punished severely. For the short treasury trade, I am watching economic data closely, payroll numbers, jobless claims, retail sales, manufacturing surveys. Any sustained weakness in the data will shift the narrative from higher for longer to the Fed needs to cut. That shift will be sudden and violent. For the long dollar trade, I am watching interest rate differentials and central bank communication. Any dovish shift from the Fed, any hawkish shift from the Bank of Japan or the European Central Bank will narrow the rate differential that has supported the dollar. I am also watching capital flows and foreign exchange reserves for signs that foreign buyers are becoming less reliable. There is another catalyst I am watching closely that could affect all three of these trades simultaneously. A policy accident. Central banks have been navigating an extremely difficult environment, trying to fight inflation without causing a recession, trying to maintain financial stability while tightening monetary conditions. The room for error is small, and the consequences of error are large. If the Federal Reserve over-tightens and causes a recession, all three trades reverse at once. AI spending gets cut as corporate budgets tighten. Treasuries rally as the Fed cuts rates aggressively. The dollar weakens as rate differentials collapse. The correlation between these trades during a policy accident could be extreme, meaning portfolios concentrated in these consensus positions could suffer devastating losses. If there is a financial accident, perhaps triggered by stress in commercial real estate or private credit or some corner of the market we have not focused on, the same dynamic applies. Risk-off environments are typically negative for growth stocks, positive for treasuries, and often negative for the dollar as capital flows reverse. The crowded positioning across all three trades creates systemic fragility. This is why I think in terms of scenarios and tail risks, not just base cases. The base case might be that these trades continue working for a while longer, but the tail risk, the scenario where everything goes wrong at once, is underpriced by markets and underappreciated by investors. Managing for tail risk means reducing crowded positions, even when they are still working, because the cost of being wrong in the tail scenario is catastrophic. Let me also talk about the psychology that keeps people trapped in crowded trades, because understanding this psychology is essential to avoiding the trap. There is enormous career risk in being different from the consensus. If you reduce exposure to AI stocks and they keep going up, your clients complain, your performance lags, you look stupid. If you are long treasuries when everyone is short and rates keep rising, you lose money while others make money. The pressure to conform is immense. This career risk creates a perverse dynamic where professional investors stay in crowded trades even when they know the risks. They tell themselves they will get out before the reversal. They think they are smart enough to time it. But everyone thinks that. And when the reversal comes, everyone discovers simultaneously that they cannot all exit through the same door. I learned this lesson the hard way in 2000. I knew technology stocks were overvalued. I knew the bubble would burst, but I thought I could ride the momentum a bit longer and get out before the crash. I lost $3 billion because I underestimated how fast the reversal would happen. The memory of that loss has shaped my entire approach to crowded trades ever since. The individual investor actually has an advantage over professional investors in this regard. You do not have career risk. You do not have to explain quarterly performance to a committee. You can be different from the consensus without losing your job. This freedom is valuable. Use it. I want to be clear about something. I am not predicting that these reversals will happen next week or next month. Crowded trades can persist for longer than anyone expects. That is what makes them so dangerous. People get comfortable. They add to positions. They dismiss the warnings because the trade keeps working. And then, suddenly, it does not work anymore. My job is not to predict exact timing. My job is to assess risk and reward. And right now, the risk-reward on these three consensus trades is terrible. You are taking substantial risk for limited upside because most of the move has already happened. and you are positioned alongside everyone else, which means the exit will be brutal. When sentiment shifts, the investors who build lasting wealth are not the ones who chase the hottest trades. They are the ones who recognize when trades have become too crowded, reduce exposure before the reversal, and have capital available to deploy when opportunities emerge from the carnage. That is how I have operated for 4 decades. That is how I made money in the 1990s bull market and the 2000 crash and the 2008 financial crisis and every other environment. The 3 trades I have warned you about today will reverse. They always do. The crowding guarantees it. The only questions are when and how severe. You can wait until the reversal is underway and try to exit with everyone else. Or you can start reducing exposure now while there is still time. I know which approach has served me better over 40 years. The consensus is seductive. It feels safe to own what everyone else owns. It feels scary to be different, to reduce exposure when positions are making money, to sit in cash when others are fully invested. But the safety of consensus is an illusion. When the reversal comes, you will discover that the crowd offers no protection. You will be one of millions trying to sell to a market with no buyers. The greatest fortunes in investing are made by being positioned correctly for the turn, not by riding the trend to exhaustion. I have spent 40 years studying these cycles, learning when to follow and when to step aside. The signals today are clear. The crowding is extreme. The risks are elevated. The time for caution is now, not after the reversal begins. I have given you the warning. What you do with it is up to you.